Hey there, Canadian Wealth Secret Seekers. It's Kyle here again for another Friday edition of the Canadian Wealth Secrets Secret Sauce episode for this week. We, every single Friday, release an episode that tries to be a quick hit, a quick win for you to walk away with more knowledge, more tools in your tool belt to help you along your personal or your corporate wealth building journey. Today, if you enjoy this episode, we so appreciate if you hit that follow-up button and also do us a favor and leave a rating and review and share it in the same way you found this podcast. All right, let's dig in today. I have a question from a current client right now. This is how most of these episodes are inspired. They're questions that we hear from you folks who reach out to us and ask us for a discovery call to review your scenario or in order to work with you on some of your wealth building journey. In this particular case, we've got a business owner who is earning quite a bit of active income each and every year, but also recognizes that getting that income out means basically giving back a lot of the tax efficient or tax reduced sort of income tax rates that small businesses receive through the small business tax deduction. So what we're going to do here today is we're going to talk about a policy in order to help this particular individual. And the question they had was, okay, they're sold on the idea that they need to get as much of their active income to hit a corporate-owned life insurance policy as they possibly can, but they're wondering, like, where does the money go? And when we look at a projection or an illustration, as we call it in the insurance industry, when we're looking at permanent insurance, we'll actually look at essentially a roadmap. It's like a blueprint of what we're hoping will happen based on some assumptions. So when we have assumptions, we know that it's going to be hard for it to be perfect, but we get a general sense. Now, why don't you see an illustration when you go into a mutual fund company, when you go into the big bank, when you buy an ETF? Why don't you get this? Well, because typically the volatility is so high that it's going to break almost immediately. Whereas with a participating whole life insurance policy, we do have some background knowledge that we can work with. Like, for example, the current dividend rate that they're paying on these policies, plus all of the guarantees. So when you look at an investment product, you don't really have the same types of guarantees. Now, maybe you could do this with a GIC, but you're looking at a 2-year projection or a 5-year projection. It's fairly obvious, right? You're getting interest and that's all you're getting and that's it. And then you're going to get the money back. So there's no real need for a projection there. But with anything that has volatility in it or unknowns, it makes less and less sense to actually do an illustration. So in the insurance space, we do it because there are guarantees. However, there are also some non-guaranteed scenarios that we're going to talk about here that we don't know for certain, but we can at least better understand the more we understand how these policies are actually invested. So what we're going to do is we're going to explore, where does the money go first, so we have an understanding of how this all works. Like, a question that a lot of people have is, hey, what are they doing with my money and how does the insurance company actually make money? Like, obviously they're going to do it for personal benefit, personal gain. Of course, they want to make profit. What they're doing is they're taking this money, specifically when we talk about a whole life insurance policy, goes into what we call the participating investment fund. And this fund works much like a pension fund. So I'm going to bring up two insurers, two of my favorite. One is Equitable Life. They are here in Ontario. They've been around for over 50 years. They've been doing great things, and they have a lot of flexibility, especially with those business owners who have retained earnings. And this is also great on a personal side, by the way, for those who don't have a business and are listening and want to understand this more and more for themselves. Equitable has very flexible terms. They have the lowest policy loan interest rates right now. Now, could that change in the future? Of course, we don't know, but that's where they are competitive, and they have a pretty solid dividend scale currently, and they have, historically over the past little while. So smaller than some of the big guys, but a great company. And full disclosure, I have some of my policies for my family, my corporations through Equitable Life. And we'll share another one in a second. But what I want to share out of their annual report from 2023 is their asset management. And what you're going to notice, their general fund managed assets looks kind of like this. And if you were to actually put this up against, say, something like like a pension fund, what you would notice is that the split is going to be fairly similar. Like you're going to notice it's fairly balanced, it's fairly conservative. So again, we're not really looking at this as an investment. This is a tool. We use insurance as a tool, not as an investment. We're not going to sell off all our S&P 500 index, stocks, ETFs, all of those things in order to fund it all into a policy, unless you're in a balanced fund anyway, and you're earning around the same 4-ish%, and for some people that's, 4% and then taxed on top of it. Sure, there's an argument to be made there. But I mean, hey, if you're in an index earning 8, 9, 10%, then we're not comparing the same thing. We want to talk about this as a tool. Right now, we're going to talk about it as a tool to help us deal with retained earnings inside a corporation. We want those retained earnings to hit a policy so that that policy can not only grow tax-free, bonus, but it gives us leverageability to invest in other assets, creating more of a tax issue for ourselves on a capital gains perspective or potentially passive income perspective, depending on what it is. Again, tax issues mean we're getting more assets, which means we are increasing our wealth. So that's a good problem to have, and this tool can help us deal with it. So they're taking this, they're putting it into a fund. You'll see here almost 50% in bonds and debts. And then you see mortgages and you see, investment properties, private placements, all these different assets over here. The same's true when we look at something like Sun Life, like the big guys, right? So Sun Life, look at their split. Their split is very similar when we look to how they're investing in the participating account. So what are they doing? They're trying to make money on your money, just like a mutual fund does. A mutual fund takes an MER, they take a management fee from it. They're doing the same thing here. The difference is that you're getting a lot more of the upside in, say, a fund than you are in a policy. What you're getting from a policy is you're getting all of these other contractual guarantees. You're getting a death benefit, you're getting a cash value you can leverage against. You're also getting a tax-free death benefit at the personal level, as well as even corporately. You get a tax-free death benefit to the company, and then that company shareholder can take a tax-free capital dividend or a tax-free dividend from the capital dividend account credit that it will receive. So it is a massive, massive help in helping us to repurpose these retained earnings and remove the tax target that's on the back of the retained earnings. So the company's taking your money, they're investing the money, and then they're going to give your policy, as a policyholder, your policy is going to receive a dividend each and every year. We're going to look here at a policy that I ran for a client recently. This particular client is looking at overfunding a policy, and they're planning to do it for a 10-year runway, or at least that's the scenario we're looking at here. So they're doing a base plan for par whole life, which is about $38,000, and they get about $60,000 of this paid up additions room. That's sort of like the high octane fuel that you can stuff in this policy to allow for a high early cash value, to allow for high leverageability in the early running so that you can reinvest in other assets. Or if the policy was a bigger policy per year in terms of premium, we could look at personal leveraging ideas and strategies in a compliant way in order to help minimize taxes at a personal level. But in the meantime, let's look at what's happening with this particular policy. And, again, they're investing that money. And then the question becomes well, where do we get the numbers in an illustration? You're going to notice that you'll see two sides. You're going to see on the left side, you're going to see guaranteed values, which is, I think, over that way. And right above my head here, you're going to see non-guaranteed values. So let's start on the left side here. The left side is the guaranteed values. This is what is contractually guaranteed at minimum to happen here, meaning that at base case, this is what will happen. If you put in the minimum amount of about $38,000, the cash value in year one, they guarantee that by the end of year one, it's going to be about $22,000. That's the base. This is like what they're guaranteeing at minimum. So you're going to get that or better. The death benefit's going to be almost $5 million guaranteed. That is what they're guaranteeing in year one. And you can see over time what it looks like over time. Now, if that was all we were getting, then, again, this could be helpful for estate planning, but it's not very helpful for us when we're thinking about reinvesting or leveraging for purchasing more assets or leveraging at a personal level in order to minimize income taxes. What we want to do is we want to look at, okay, let's talk about some of the unknowns here. So here's the unknowns. When we go to the current dividend scale non-guaranteed values, what we're talking about is what they're currently paying in terms of dividend scale. So what they are paying currently may change in the future, but if it stays exactly the same, this is what would play out, assuming that in this case, we're looking at this individual putting $100,000 in for 10 years. If this person does 9 years, then obviously this illustration is going to be different. The outcome will be different. They've not done what they said they would do or what they're planning to do, so it's going to change. Now, here's the beauty. They can decide later if they want to go to year 11 or if they want to go to year 9. Here we're just showing what would happen under the assumption that they did $100,000 for 10 years straight each and every year, and the dividend rate stayed the same. Because remember, the dividend is not a contractual guarantee. This is just something that they do each and every year, but they don't tell you what that number will be. Just like Apple or any dividend paying stock doesn't guarantee you that there will always be a dividend. They can cut the dividend at any time. They can turn it off. They can improve it, increase it. Now, of course, just like with a stock, if they were to take away the dividend completely, that would be detrimental to the share price. Well, the same is true here. If they stop paying a dividend, then obviously people would stop trusting this as the tool that they were after, which was, hey, we like this dividend. And in this case, we're going to have the dividend reinvested into more death benefit in order to grow the death benefit more drastically each and every year. And we also want it to help us with our cash value. So what this current policy is worth in year 1 or in year 2 or whatever timeline we are looking at. So what would actually change this particular scale? Well, here's what I can tell you is that when we did this particular scale, this was right after they announced a dividend scale change. They actually increased the dividend scale from this particular company. This one's an Equitable Life insurance illustration that I'm sharing with you. This particular one is based on the new dividend scale that we're going by. Now, had they reduced the dividend, well, then the entire illustration would break starting right now, right? Like if you literally did it and they changed the dividend scale the very next day, then all the numbers are going to be wrong, right? The entire thing will be wrong for the rest of time. Now, in this particular case, the entire dividend or the entire illustration is going to be wrong for the rest of time in the best way possible, which is the numbers are actually going to be higher. So that's really what's going to dictate how this looks from year to year. And there have been people in the past who have shared that, hey, I had an illustration that said this, but it didn't turn out that way. It was actually a little less. Now, who you usually don't hear from are the ones where it happened in the opposite direction, right? When it goes up, they're not really vocal about it. They're just happy and they move along. So that is possible. That is what would happen here. But we do know what is guaranteed based on the minimum amount, right? What they're not showing is what's going to be guaranteed based on if you maximum fund this thing. But you do get to see what sort of the current case scenario is based on last year's dividend or the last dividend scale that was declared. So with that said, we can trust these policies only to an extent, but how do they decide on these actual dividend scales? This is what is really important because here's what we love about it. We want to be utilizing these policies not only to help us as business owners through the use of the capital dividend account to help get more money out tax-free to shareholders later, and to leverage tax-free in order to buy more assets in the company or use leverage strategies in a compliant, structured way to, pay less taxes personally. We want to do all of these things. Well, what we want to do is we want to figure out, okay, well, what if the dividend went down, but something like interest rates went up? So my loan amount or my loan cost goes up. Well, my dividends went down. Well, the beauty of a permanent whole life policy is that typically what you see is that dividend rates go up in high interest rate environments, and they tend to go down in lower interest rate environments. So I'm showing here a chart from Sun Life. This is available to you. This is their Sun Life participating account PDF that's available. And we see tracking some different interest rates from 91 onward to about, I think this goes to 2023. So you can see what they declare as their dividend scale and the interest rate. And then you also see the different interest rates. And what you'll notice is if we track, for example, the 5-year GIC rate in 91, it goes down, and then it kind of goes back up and up again. Well, look at Sun Life par dividend scale interest rate. It went down, and then, it actually went down a little bit further before rates, but then rates went down again. And as they continued going down, what you're going to notice is that the dividend scale rate goes down as well. Well, why is that? Well, if we go back to the asset allocation that we explored, a lot of it is in very interest responsive type investments, right? If over half of your fund is in interest bearing or fixed income type assets, then typically what you're going to find is that as interest rates go up, as the cost of borrowing goes up in the world, typically the dividend rate's going to go up over time. And the opposite is true as well, which is actually what we want. I'm less concerned about what my illustration really does and more about it being more movement in tandem between when I go to leverage these policies. If I'm leveraging at a higher interest rate, I want my dividends to be rising as well. And the opposite's true as well. If I'm in a low interest rate environment, my dividend rate's going to go down as well. So the people that are saying like my illustration said something different, well, hey, talk to the person who got a policy in 91 like you see here, where the dividend rate scale is 10.9. So if your policy was illustrated in 91, the dividend rate's really high because we're in a really high interest rate environment. Well, guess what? 20 years later, when it's 2010 or so, your dividend rate got cut from 10% to 7%, but your actual 5-year GIC went from 8%, almost 9%, down to less than 2%. So you can't have your cake and eat it too is basically the messaging here. So you're happy because your mortgage rates are down. You're happy because you can borrow on cars and you can borrow on, unleveraged or borrow on, non-collateralized loans at a lower interest rate. Well, you also have to accept that your return on the actual dividend, the dividend scale on your policy is also going to likely go down as well. That is a good thing if we're using this tool as a leveraging tool. We don't want them working in opposite directions. So a lot of times clients such as the one that I'm creating this particular episode for here today, they're asking like, well, what could make my illustration go sideways? Meaning I've got this plan, I've got this idea, maybe later they're looking to maybe utilize some of this borrowing power for income in retirement or something along those lines. They're going like, what could ruin this? And really, nothing can ruin this, quote unquote, unless the insurance company was to go completely belly up. Now, that's another wealth secret sauce episode that we can go into. But let me put it this way, that if our insurers in Canada, specifically Sun Life and some of the bigger ones, but also Equitable Life would fall into that bucket, in my opinion, if they were to go belly up, then we've got another issue because I'm going to argue that our banks are also going to be underwater because our insurers have much higher standards in terms of what they can do with the assets than the banks do. The banks get to leverage the money multiple times. They get to send it out and give it out multiple times, whereas insurers are not able to do as much leveraging as the banks are. So we'll leave that for another episode. But ultimately, at the end of the day, the illustration is really to give you a sense as to what this might look like and sound like, that the growth of your cash value and your death benefits happening in a tax-free and a tax-efficient way. And that when we leverage against our cash value, we're in a position where we can essentially continue to scale up our assets or get tax-free access to money in our pocket in a very easy and safe way. Because once again, our borrowing rates are going to be moving in similar tandem, not in exact proportional tandem, of course, to the dividend rates inside our policies. So that is the real goal here. That is the secret sauce for today's episode. So if any of this has resonated with you, if you're learning something by being a listener of this podcast, if this is helping you think through your own personal or corporate wealth building journey, please don't keep it to yourself. Share it out on social media. Do us a solid and leave us a rating and review on Apple Podcasts. And of course, for anyone who would like to have a chat and really take a deep dive into your personal and corporate wealth management situation, reach out to us at CanadianWealthSecrets.com/discovery, and you can hop on a free discovery call so that we can go down the rabbit hole and find you a next step that makes sense for you, your business, and your investments. We'll see you then.